So good evening, everybody. In our last class, we discussed discounted cash flow, talking about investment appraisal, and we look at one of the method of investment appraisal using the discounted cash flow approach, which is NPV, that is net present value. Net present value. So today we're going to continue that discussion by looking at the internal rate of return. Internal rate of return. When we talk about internal rates of return, we are simply referring to the rate that equates the net present value of expected future cash flows to zero. That is the internal rate of return. So internal rate of return is the rate of return that equates NPV to zero. So, and when we are solving internal rate of return, we have to consider issues of relevant costs, relevant cash flows. And we said in the last class that relevant cash flows are cash flows that has to do with future decision making. So internal return can be as a discount rate at which the present value of all future cash flows is equal to the initial investment. So if your initial investment is 200,000 and all your cash flow is also 200,000, 200,000 minus 200,000 will give you what? Will give you zero. Will give you zero. So as a result of that, your internal rate of return will be zero. So internal rate of return is the maximum cost of capital that can be applied to finance a project without causing any harm to the shareholders. Why are we bringing the shareholders here? Because they are one of the major stakeholders in the business. So by the time you are trying to invest in a project and it will harm the ordinary shareholders, they will frown at it. They will not be happy. So you must always consider their interest in whatever decision that you want to take as a financial manager. So internal rate of return is also known as what? As the discounted factor yield. Take notes. The examiner might not tell you calculate. They might just tell you that using the discounted yield approach, using the internal yield approach, using the discounted rate of return approach, using the break-even rate approach, using the market discount rate approach. So these are synonyms to internal rate of return. Yes. What am I saying? That another name for internal rate of return can be what? Internal yield. Can be discounted rate of return can be what? Break even, and it can be what? Market discount rate. So this internal rate of return is the approach was in the last class talking about NPV. So similar to NPV, internal rate of return account for time of cash flows. For time of cash flows, value of money is also very important. Is also significant, and that is why it is classified under what? Discounted cash flow techniques, because in discounted cash flow techniques, we consider issue of what? time value of money. So discounting means what? When we talk about discounting, we are referring to what? Accounting for time value of money. Accounting for time value of money. So to compute internal rate of return, it is calculated using the trial and error method or interpolation method. It's computed using the trial and error method or the interpolation method. The interpolation method. Take note so that when we start solving, though I know sometimes we try to see how we beat the time in exams, but the concept is in internal rate of return, you use the trial and error approach. And why are we coming up with trial and error approach? Because the trial and error method involve calculating what? NPV that will yield two opposing results. What do we mean by two opposing results? It means one NPV will give us a positive result and one will give us what? A negative result. And once we determine these two variables, what do we do next? We input the calculated NPVs into the internal rate of return formulas. And once we do that, we'll get the IRR, which will be what? Which can serve as the cost of capital for you to invest in a project. It can serve as a benchmark for you to invest in a project. So while we're talking about issue of cost of capital, we under the redeemable and irredeemable debt, we show ourselves the formula to compute internal rate of return, because for you to determine the cost of redeemable debt, you need the knowledge of internal rate of return. And during that class, I emphasize on this so that when we come to this point, we'll have less work to do. So looking at the internal rate of return, the first step is what? Calculate the net present value using what? A trial and error approach by selecting what? An arbitrary cost of capital, which may gives what? A positive or negative NPV. Yes, which may give a positive or negative NPV. Let me remove this here. So step 2 is if NPV computed in A is positive, use a second rate that is higher than the first rate. It means if you use 5% and you have a positive NPV, for you to get a negative NPV, what will you do? What will you do? It means that
You have to increase the percentage.
you have to increase the
The
percentage.
percentage.
So if NPV computed in A is positive, use a second rate that is higher than the first rate to give a negative NPV. So if NPV computed in A is negative, use a second rate that is what? Lower than the first rate. And that will give you what? That will give you a positive NPV. Hope this is clear. If this is your first time of coming across this. Any question about this?
It's clear, sir.
It's fine. Sorry, trying to switch to my other laptop. Let me see if I can switch now. So we'll look at an example. Or before we look at an example, let's talk about the decision rule. The decision rule when using internal rate of return. Still, we can have issue of independent projects, and we can have issue of what? Of mutually exclusive projects.
Hello, sir, we can't hear you again. Sir,
Can
you
you hear
can
me,
unmute
please?
yourself. Yes, we can hear you.
You can hear me, right?
Yes, sir.
Yes. Sorry, I have to switch. I have to switch. Let me see. So I said we can have. Can you see my screen, please?
Not yet, sir.
No, no, no,
Not
No,
yet.
sir. We
Sir, your
can't.
video is on.
no.
Share my slide now. Okay, fine. So can you see my screen now?
Yes.
Yes, sir.
Yes, we can.
All right, fine. So we are going to talk about the decision rule. In talking about the decision rule, we can have a case of independent projects and mutually exclusive projects. In the last class, we defined what independent projects are and what mutually exclusive projects are likewise. So for independent projects, the decision rule will be that what? You accept a project if the internal rate of return is greater than or equal to the company's cost of capital. Because in the question, you have a cost of capital in existence. So the decision would be once you compute and the internal rate of return you derive is less than the one quoted in the question, it means you have to reject because the results, which is less than what is quoted in the question, will bring down the value of the company. But once the one computed is greater than the one given in the question, you accept because there will always be a benchmark set by the organization that any investment that will be less than 15%, 10%, that will give us a return less than 15%, 10%, we are going to reject. But once an investment is going to result into 20% greater than the benchmark that we've set, we should accept. So for independent projects, accept a project if the internal rate of return is greater than or equal to the company's cost of capital. For mutually exclusive projects, the decision rule is you accept any project with higher internal rate of return, provided that what it is greater than the company's cost of capital. So for mutually exclusive projects, it means you have quite a number of projects competing for same resource. So among these projects, which of these projects is going to give you a higher internal rate of return? That will be the basis of your decision in terms of the decision rule. In terms of the decision rule. So, talking about the advantages of internal rate of return, what are the advantages that you can think of associated with the internal rate of return? The advantages, number one, we can look at the issue of time value of money. We can say that internal rate of return accounts for the timing of cash flows and time value of money. That means it recognizes inflation, it recognizes deflation, it recognizes the the prevailing economic condition associated with money as at a particular point in time. And that is why the issue of discounting set in. And another advantage we can talk about as it relates to, let me see, I think I have those things here. As it relates to internal rate of return, we can say that the internal rate of return is usually in percentage, and therefore this can be easily understood by non-financial managers. So, and one more thing is that it uses cash flows rather than what accounting profit. In the last class, we defined what accounting profit is. We said it is the profit less depreciation. So, for you to get your cash flow where you are giving profit, you need to determine your depreciation, add your depreciation back to your profit, you get your cash flow. So, and one more thing is that for internal rate of return, it considered all the cash flows throughout the project life, just as we discussed in the case of MPV, that it considers the whole cash flows throughout the life of the project. Talking about the demerits, disadvantages of internal rate of return, to somebody that is not financially inclined, they can see it as a difficult task. Now, most organizations actually practice these in reality. Yes, in reality. And organizations that practice these in reality, they don't do it on paper. They do it on spreadsheets. They have a spreadsheet program where they compute MPV, where they compute internal rate of return using pivotal table to show the expression of a decision that should be made by an organization. So, but because of exams, or because of the fact that I discovered some students are still having the phobia of using the computer to write exams, but looking at ACCA and how you compute these in ACCA exams, you use your spreadsheet to compute all this and you formularize your cells to get your result. So when that is the case, you can discover that internal rate of return is can be difficult. Yes, it is difficult to calculate, especially where the use of spreadsheet program is involved. And one more disadvantage of this is that the use of interpolation, the use of interpolation only provides an estimate, and an accurate estimate requires the use of a spreadsheet program. Yes. So interpolation, the use of trial and error is just a trial, and an accurate estimate is required for you to make a very good decision. Not doing trial and error. It shows we don't know what we're doing. We don't know what we're doing. So, but this is based on source. We have to criticize this, but this is just based on education and what the exam wants us to do. But in reality, there is more to this. So, another disadvantage of internal rate of return is that it produces multiple results where there is unconventional cash flows. Talking about unconventional cash flows, where the cash flows are not sequential, when the cash flows does not recognize the issue of time value of money. So, or where the cash flow is historical in nature and does not reflect the reality of things in the economy. So, it can result into results multiple results that might not be actually acceptable. So as the question comes in exams, based on the scenario, you think of a very good thing to write. Yes. Using internal rate of return to try to determine. All right, Madam Chuma.
Sir, thank you so much. But what I'm seeing here is that the MPV and the IRR, they are having almost similar advantages and disadvantages, just a slight difference from that of IRR.
Yes, same advantages and disadvantages now,
Okay.
because they all fall under discounted cash flow. So same advantages and disadvantage, just little condition.
Thank you, sir.
So for you to solve internal rate of return, you need this formula, as you can see on the screen. So as we determine your MPV in positive and negative values, you substitute into this formula, as you can see on the screen, that use the two MPV values generated to determine the internal rate of return. And the formula to apply is this. That is, internal rate of return is equal to A plus MPV of A divided by MPV of A minus MPV of B, all multiplied by what? B minus A. And what is B? The highest discount rate, and A is the lowest discount rate. So if this is your first time of seeing this, you can write it down so that when we try to apply it in a question, we'll not ask too much question. So this formula can be expressed in another way. They can write it in another way. Some authors might decide to just, they might not put MPV of A. They can decide to write it in another form. So don't get confused. They are all telling you same thing. They are all speaking the same language. So let's look at an example. Let's take an example to illustrate this. Let's write. I will not want to use, I will still come to the example I have in my slide, but let's add some value. Let's come up with this. Evo Limited. Evo Limited is considering Evo Limited is considering a project with the following estimated future cash flows. Estimated future cash flows. So we can have year, we can have cash flow. Year 0, we have a cash flow of what type of cash flow now? An outflow of 150,000. And we have year 1, we can have a cash flow of what? 60,000. That is an inflow now. Year 2, we have a cash flow of what? 75,000. Year 3, we have a cash flow of what? Of 50,000. Year 4, You have a cash flow of what? Of 25,000. Madam Macaulay, are you in this class? He's not here. The company's cost of capital. The company's cost of capital is 10%. Company's cost of capital is 10%. Required. What is the internal rate of return, IRR, of the project? And advise if the project should be undertaken. The project should be undertaken. What will be the first thing to do? Looking at this question. Mr. Ivo, you will lead us because I've used your name now. So tell us what will happen.
Okay, we will calculate the NPVs first. The NPV of the using the lower and the higher rate.
Okay. So we'll calculate the NPV. In calculating the NPV, we need to assume two rates. Yes, I discovered that sometimes some students will just go and pick this 10%. Fine, you can pick it. But the fact that it is given in the question is not the basis for you picking it. The basis of this cost of capital, this is the ceiling, the benchmark, that any result you are getting that is less than 10%, you should reject. Any result that you are getting, that is the IRR you are getting, and it's higher than 10%, you should accept. Yes. Because I discovered in the last diet, somebody asked me that we are to use this and choose another one. Yes. But you can decide to use 10% if you have a positive NPV. The next thing is to increase to get a negative NPV. But giving you this is just like a benchmark that once you compute and you calculate your internal rate of return and you get, let's say, 8%, it shows that you should reject the project. But once you compute and you have 15%, 20%, anything above 10%, you should do what? You should accept. Because the decision rule is that what? Accept a project if the internal rate of return is greater than or equal to the company's what? Cost of capital. So for this question, solution. Calculate two opposing NPVs. Calculate two opposing NPVs. Two opposing NPVs. First, I'll assume 15%. And see what it will give to us. Assume 15%. I discovered in the last diet too, because we say assume, the student went to use 99%. After she used, let's say, 10%, she now went using a wide margin. I said, okay, that is interesting. You don't need to go far. Yes, because what you are looking for is right beside you. So looking at this question, how many years are we looking at? We have year 1 to 4.
4 years.
4 years.
So
4 years.
we have the years, the period of investment, which is 0. We have year 1. We have year 2. We have year 3, and we have year 4. 3, and we have year 4. So the details,
Network is breaking.
the details, the initial outlay will be cash flow. And the initial outlay, what type of cash flow is that? It's a cash outflow
Outflow.
of what? 150,000. 150,000. So we're assuming 15%.
The network is breaking.
Please, my network that is breaking, is it peculiar to only her, or is
No,
to
sir.
everybody?
Also me.
So your network is breaking.
All right, it will not break. Once I think I'm getting some messages. That is why it is breaking. Shouldn't break again. So the PV for the year 0, the discount factor will be what? Will be 1.
1.
The PV will be what? 1 multiplied by 150 will still be what? 150.
Minus.
For year 1, our cash inflow is what? 60.
60.
We have cash flow of 60. When you are discounting, since it is not a constant cash flow, what are we going to do?
We do
Since
it
Use
individually.
discounted rate.
Discounted rate.
So the discounted rates at 15%. So for year
Yes,
1,
sir.
what would that be?
0.870.
0.870. For those that are just joining, I don't know, if there's anybody that's just joining. Since we don't have a constant cash flow, we use this approach. That is 1 plus what? The assumed percentage of 15%. That is 1.15 to the power of -1 for year 1. Once you do that, you should have what? 0.870.
870.
Just 1 minute, please. 10 minutes. So you have 0. What? 8. When you approximate to 3 decimal places, let's approximate to 3 decimal places.
870.
870.
870. So once you multiply 0.870 by 60, what will you have?
52,200.
52,200.
2,200. Sorry, I'm not yet typing. Trying to All right. Okay, fine. So we have it as 0. What? 870. And you multiply, you have what? 52.
200.
200.
For year 2, the cash flow is what?
75,000.
75,000.
75,000. So at year 2, the discount factor will be what?
0.756.
0.756.
0.
756.
Multiply by
756.
multiply by 75,000.
56,700.
6,700.
And for year 3, the cash flow is what?
50,000.
50,000.
50,000, sir.
The discount factor at year 3 will be what?
0.658.
0.658.
0.658.
0.658. And when you multiply, you have what?
32,900.
32,900.
For year 4, the cash flow is what?
25,000.
25,000. So the discount factor,
0.57.
0.572.
and you multiply
25,000,
that, you have
14,300.
14,300.
your MPV will be what?
6,100.
0.572. 14,300.
Yeah, that is the discount factor. Multiply by 25,000. You have 14,300. Then the
6,100.
MPV will be
6,100.
6,100.
6,100.
So using
6,100.
yes, 6,001. Using 15%, we are able to arrive at what? A positive value. For you to get a negative value, what are you going to do? You increase.
We increase the
Increase it, sir.
So let's assume 18%. So somebody should not go and assume 100% because we said it's trial and error. Assume 18%.
Let's use 20.
You can use 20. Don't worry. You can every individual. If you are solving it on your own, you can use anything. We should still arrive at almost same range. Use 20
Sorry.
to solve it. In exam hall, we will not use same rates. So the point is, your final result will be within certain range. Once you are going outside the range, the marker will know that this is wrong.
Okay, I'll use 20. 25.
So assume 18%. So for year 1, using 18%, your result will be what? Your discount factor will be what?
0.847.
847. Multiply by 60,000. We have what?
5820.
5820. For year 2, using 18% as discount factor,
So
is
cancel the previous one.
you said?
Do you cancel the previous one?
As in, did I cancel the previous one?
Yeah, using 15%.
Sorry, I didn't get your question. I want to get your question very well.
The discount factor. Did you cancel the workings? Oh, okay.
It's
Okay.
so for year 2, the discount factor at 18% will be what?
0.718.
Multiply by 75,000, we have what?
53,850.
3,850. Then for year 3, the discount factor will be what?
0.609.
Multiply by 50,000.
30,450.
30,450. And for year 4,
0.516.
0.516. Multiply by 25.
12,900.
5,900. So our MPV will be what? If we didn't get positive or negative, we'll do another one.
It's positive.
It's
Positive.
negative. Oh. Negative.
Okay.
Let me add, sorry.
Negative.
Negative.
1,980.
It's negative.
So we are now fit to substitute all this into the formula. See it here. This one. Let me copy all this. So using this formula, what are you now going to do? Now, based on what we've computed, what is A? This capital letter A. What is A?
15%. 15%.
Yes. Why is it 15%? See it, lowest discount rate. Comparing 15 and 18%, which is lower? 15. So this A will be what? 15%. The A will be what? 15. Now, what is MPV of A? This MPV of A.
6,100.
6,100. Positive one.
Yes. MPV that gives positive MPV using the lowest rate. So it is what?
6,100.
6,100.
Wow.
Then for the denominator, MPV of A will still be what? 6,100. MPV of B will be what?
1,980 negative.
So this, your B is what?
1,980.
What is discount rate? 2018.
So use your calculator. your internal rate of return will be what?
17%.
17%.
Wahala.
Madam Chuma, any question? Any question?
412.
Somebody said, "Wahala." Any problem with? I'm even ashamed of myself solving this because
I have a
it's look
question.
childish. Yes.
For that of the 18%, we had a negative value of 1,980, but underneath
Yes.
6,100, share is minus, let's say minus 19,980.
Yes. Very well. Very well. Yes. So it's minus minus. So the result should be positive here. This should be positive. Yes. Thank you for that. So the person that have derived 17% use the right formula. Yes.
17% is correct.
Yes. So originally should be like this, minus into the bracket of this. So minus by minus will now change to what? We change to plus. So we have it as 17%. So what is your advice to this company, to this organization, to Mr. Ivo Limited? Mr. Ivo,
Sir,
what will be your advice? What will be your advice now?
the company should accept the project since the computed internal rate of return is higher than the company's cost of capital, which is 10%.
Yes. So the project IRR of 17% is higher than the company's cost of capital of 10%. So the project is financially viable and should be undertaken by Evo Limited. So that about this. In this class, you don't understand this internal rate of return. Raise up your hand. Because we've treated it in, let me see the hand. Okay. Madam Esther, talk to me.
I didn't get it 17%.
So how are you pressing your calculator? You treat this one first. See this one, 61 all over 61 plus 1980. Treat that one first. When you treat that one, you get the result. You now multiply by what? By 3, because 18 minus 5 is 3. Before you now add. So you follow the rule of God math. You get?
Okay.
So press that 17%. So based on the syllabus I forwarded, that aspect of the syllabus I forwarded that we have to discuss in the last class, these are the two issues of discounted.
Oh, I got it.
These are the two issues of discounted. Let me go and check it, so that I'll be very sure of what I'm saying. These are the two issues of discounted approach. Let me go and confirm. It's very important. I'm following what is in that syllable. It's net present value and internal rate of return. So the next we have to look at is payback period. Payback period and accounting rate of return. Payback period and accounting rate of return. Payback period and accounting rate of return. But before we move into that, though we discussed it in the last class, talking about issues of relevant cash flows, issues of relevant cash flow for capital investment. Now, when we talk about relevant cash flow, we said these are cash flows that are important for decision making. So one thing we must know is that cash flow is one of the variables required in determining what the financial viability of a project using the discounting techniques such as the MPV and IRR. So these cash flows.
Hello, sir.
Yes.
Okay. I used the 20%, and I got 17.334.
Yes. So that is a testament to the fact that every individual can use any rate and you still come within the same results. Yes, you still arrive within same range, because if 200 students are writing this course, you will not, I'm not seeing your work. I will use a rate that I feel like. So definitely we should arrive at same results. Close, might not be perfectly same, but at least. So talking about the issue of relevant cash flow for capital investment, so the relevant cash flows are cash flows that must relate to the future. And this cash flow must be directly attributable to the course of action that the investment decision is to be taken on. So relevant cash flows variable costs. They are variable costs. Yes. Relevant cash flow are variable costs. So these are relevant costs that can directly attributable to activity level. So that is, if activity level changes, total variable cost will also change. So that is why variable cost is what is a relevant cost. So you must note this, because some questions can give you certain costs that are not relevant. That is why I'm coming back to this. So what about fixed cost or overhead? Fixed cost or overhead. Are these costs relevant? These are costs that have no sympathy for activity level. They remain fixed irrespective of the activity level. That is, irrespective of number of units produced, fixed cost does not change. So it is an irrelevant cost and should be ignored, except it is direct or incremental in nature. You know, we have, when you go further to analyze fixed costs, we have various forms of fixed costs. We have step fixed costs. For example, salary can be fixed for like 2 years. After some time, it changes. So depending on the question, how the question put it, but except stated otherwise in the question, fixed costs are what? Irrelevant. Irrelevant. You can have issues such as depreciation likewise or amortization. Are they relevant? Are they relevant? Issues of depreciation or amortization. These issues are non-cash items and they don't involve movement of cash. Since they don't involve movement of cash, depreciation or amortization is an irrelevant cost and should be ignored. So they can put all this in a question, trying to see or test your understanding about what is relevant and what is not relevant for you to make use of in a question. So we have issues of sunk costs, opportunity cost, working capital, and so on and so forth. When we talk about sunk costs, these are past costs that have already been incurred, and they are historical costs, which have no impact in making future investment decisions. So examples of sunk costs can include development costs. Before you set up the business, what are those costs you've incurred before the business comes to this particular stage? They are past costs. Market research costs, they are past costs. So some costs are irrelevant costs and should be ignored. So the examiner can incorporate it into a question. At that point, don't begin to wonder, what should I do with this figure? Once you have a good understanding of what is relevant and what is not relevant, and you are seeing what is not relevant in the question, you are just to ignore and move on. So let's talk about the issue of payback period. Payback period. This is a non-discounted cash flow technique. It's a non-discounted cash flow technique. And why is it non-discounted? Can somebody respond to this? Why is it non-discounted?
Because the cash flows does not have a time value of money.
Yes, does not consider the time value of money. Does not consider the time value of money. Does not consider the time value of money. So we're talking about the payback period. This is a traditional method of project evaluation, and it does not consider time value of money. So the techniques under the non-discounted cash flow include the payback period, the accounting rate of return, the payback period, and the accounting rate of return. The payback period. The payback period. This is the period usually expressed in years. So this period takes cash flows, it takes cash inflows to equate cash outflow. So the period it takes cash inflow to equate cash outflow in capital investment is termed as what? Payback period. In year 0, you invest 200,000. In year 1, you have a return of 100,000. It means you are left with how much to recoup back your investment? 100,000. In year 2, you recoup 50,000. It means you have an inflow of 150 cumulative. In year 3, you recoup back 50. It means as at year 3, you've recoup back your whole investment. So the period it takes for your cash inflow to equate with your cash outflow is termed as what? It's 3 years, which is termed as the payback period. So payback period is often used as a first screening process in order to determine the number of years it will take to recoup the initial investment put towards a project. So payback period is usually a measure of liquidity. That is how quick the company can recover the initial investment on the project. Even you as an individual, you apply this approach most times when you are trying to see how well you can utilize your money, because there is element of fear in you. So you want to see how quick, when you put your 100,000 in an investment, you test with 100,000. So in the next 1 month, you are hoping to get back an interest or a return from that your investment. So once you test with 100,000 and you discover that this return is palatable, you increase. God help you, is not a Ponzi scheme. So once you put your investment and you get that return, your appetite towards that risk will increase. So you put in more. So, but what we're just trying to say is that by the time you put a sum of money into a project, The time it takes for you to recoup back your investment is what we are trying to look at when it comes to payback period. Payback period. So payback period is a measure of liquidity, how quick a company can recover its initial investment on a project. So it should be noted that payback period is based on what? Expected future what? Cash flow, and not accounting profit. So in a question, I think we treated a question last night where we are giving accounting profit, and we are giving accounting profit, and we are expected to determine payback period. What we did in that class was to work back to get back our cash flow. So when accounting profit is given, it should be converted to what? To cash flow before calculating payback period. Take note of this. When accounting profit is given, it should be converted to what? Cash flow. What is the expression? We showed the expression in the last class. Well, let's still write it here. Let's write it here. That cash flow is equal to what? Cash flow is equal to what? Accounting profits or loss plus what? Plus depreciation. Accounting profit or loss plus depreciation. Accounting profit or loss plus depreciation. That is, you work with cash flow in computing payback period, in computing IRR, in computing NPV. Take note of that. You don't work with profit or loss. So let's look at an example. In some question, they can give you constant cash flow, same cash flow, 60,000 for year 1, 60,000 for year 2, 60,000 for year 3, 60,000 for year 4, where you are given a constant cash inflow from a project. How will you calculate your payback period? How will you calculate your payback period? You can calculate your payback period in this manner. Let's write it out. Let's write it out. With a constant cash flow, the constant cash flow, how do you calculate your payback period? How do you calculate your payback period? The payback period can be calculated as what? You can have it as payback period will be equal to what? Cash outflow. Cash outflow divided by what? Constant what? Cash inflow. Constant cash inflow. So when you do this, it will give you the number of years. Give you the number of years. You get the payback period using this approach. That is where you have a constant cash inflow. Where you have a constant cash inflow. Let's explain this with an example. Let's say Joy Limited. Joy Limited is considering a project. It's considering a project that requires what? That requires a cash outlay of what? Of 250,000. 250,000. And generates a net cash flow of what? Of 100,000 naira per year for the next 4 years. For the next 4 years. The next 4 years. See now. However, the management of the company, has set the maximum acceptable period. The maximum acceptable period of 2.5 years. 2.5 years for the project. The project to recover the initial investment. In this case, what are we going to do? But before we solve this, let me talk about the decision rule. The decision rule, even before talking about it, you should know, based on our earlier explanation of payback period. So the decision rule will be for independent projects, likewise, accept
If payback period is later.
Accept a project if payback period is lower than or equal to management what? Predetermined payback period. So if you set a timeline of 3 years, that's if I should put in my money in this project, I should recover my money at most, maximum 3 years. So by the time you do your calculation and you are getting 4 years, what will be your decision? It's to reject. So you accept a project if the payback period is lower than or equal to management predetermined payback period. So same likewise for mutually exclusive projects, you accept any project with a shorter payback period, provided that what it is lower or equal to the management predetermined payback period. So looking at this question, what are we going to do? Looking at this question, what are we going to do?
Hello, sir.
Yes.
Okay, the first one was for independent projects, right?
Yes.
This is not rule. Okay, sir.
It applies for both somehow.
The decision rule is same, either for independent or mutually. The point is, once you do your computation and you've set a timeline, when your result is higher than the timeline, you reject. Or when your result is lower or equal to the timeline set, you accept. So it's same. So looking at this question, somebody should give me the answer. I don't need to solve this based on the formula you have up there. Your cash outflow is what?
You pay back in less.
We pay back when?
Cash outflow, I think it should be 400,000 or something. Wait, That would be 2 points. It meets the
2.5.
target.
Yeah.
Yes, from the chat box, I can see 2.5 years.
Hmm.
Yes, that is correct. So the cash outflow is what? This is it, cash outlay. 250,000, right? 250,000. 350,000. 250,000. Now, the constant cash inflow is what? 100,000. So
100,000.
250 divided by 100 will give you what?
2.5.
2.5 is
2.5. Yes.
5.
so this is where you have a constant cash flow year in, year out. Take note. This is where you have a constant cash flow year in, year out. So it will be the payback period. Payback period will be equal to what? 250,000 divided by what? 100,000. Divided by 100,000. When you do this, you have a result of what? 2 points. 2.5 years. 2.5 years. You have a result of 2.5 years. So this is where you have a constant cash flow, inflow, constant cash inflow. So let's take it further. Let's look at another example. Let's look at another example.
Excuse me, sir.
Yes, sir.
So I think the year that we calculate for is 4 years. So are we going to ignore for those 4 years or how it is? Because what you did here now is a cash flow divided by constant inflow, and they give us 2.5 years. So what about the years that they give us now? Are we not going to count for the years?
Where
I
you
think
have
basically we're just considering how long it took or it will take to pay back if we invested.
let me show you in another way.
Hello.
Don't worry, let me
Hello.
show it another way. Don't worry. Let me show this in another way. This is it. As at the first year, you invested how much? 250, right?
Yes.
250. This is an outflow. In year one, you have an inflow of what?
100.
100. How much do you have left to recover?
150. Yes.
150, right? In year two, you have an inflow of what?
100.
How much do you have left to recover?
50.
We have 50.
50.
This 50 will be recovered within how many months or years? Let me ask.
Eh?
It will be recovered within how many years? This 50.
2.5.
So let's say in the third year, you have an inflow of 100 likewise. So for you to determine the number of months or years that you recover this, you've recouped within 2 years, you've recouped 200,000, right?
Yes.
You are left with 50. So if you want to know the number of months or years that it will take you to get back this 50, what will you do? Let me use this to even explain a case where you don't have a constant cash flow. What will you do? it will be, for me to know,
The
it will be
50,000 divided by
50
100
divided by what? By
100.
100. To be 50 divided by 100. So from this, at least you've helped me save, you saved me most and less work. So now the payback period will be what? Payback period will be equal to what? Now we've already recovered 200,000 within 2 years, right? So it will be 2 years, isn't it?
Yeah.
Yes.
2 years plus how many months?
6
Plus what? 50
Over
divided by
100.
what? Divided by 100. And this will give you what?
0.5.
0.5. So the payback period will be
2.5.
equal to what?
2.5.
2.5. 2.5 years. Is this clear, sir? So we are not looking at
Yes, sir.
the fourth year. We don't have
Okay.
business. That is one of the disadvantage of this method. It does not consider all the whole relevant years, isn't it? If you follow the discussion on NPV and IRR, one of the advantages is that they consider the whole useful life of the asset. But for payback period, it is not like that. It takes into consideration just the period in which the money will be recouped. And that is why you don't look at the remaining part of the third year, and you don't look at the fourth year. So,
Okay. Okay, sir.
all right. Thank you for asking the question, sir.
Thank you, sir.
At least it has made me to delve into something else and to save me more or less. I will not use more time to explain as we move on. So let's look at another question now. Let's take another question. I think the question is this. Question is this. Yes, Alan Chuma.
Sir, please, the advantages and disadvantages of
The payback period. The advantage, you should know now, it is very simple to calculate and easy to understand, isn't it?
it is.
As you are trying to solve, are you not even seeing it as, what is this?
Yes.
Is this what they will ask me in the exams?
I don't do all this one.
Yes, they will not ask you this in exam, but the application will come. But I will forward the question where it is being asked, where it was asked in ACCA. Yes, ICANN is just starting the course. So, but if you go to SFM, likewise, you see where they've asked payback period. And after this class, I will forward a comprehensive exam-like question. Yes, so that you play with it. And even this question I'm going to introduce now is an examination question, but I expect us to be able to solve it. So let me just state the advantage. One, it is simple to calculate and easy to understand, and it uses cash flow and not accounting profit. Now, what is the advantage of cash flow over accounting profit? We should ask ourselves this question. Yes, we should ask ourselves this question. Why talking about cash flow and not accounting profit? Yes, you should ask ourselves.
Sir, should I
Madam
try?
Macaulay, are you in this class?
So I'm just coming. I went very far. I'm just entering house since 4 a.m. It is well.
Okay, that is nice. You're welcome
I
back.
didn't even. Thank you, sir. Sir, why is the class 6? I thought it's 5 o'clock.
Yeah.
We even help you. You are not at home. We help you, man.
Thank you, sir.
Complaining.
Thank you, sir.
You are not at home. We move it to 5. You are still telling me.
So let me try the reason why cash flow is better than accounting profit.
All right, man.
I think the reason is that We, the accountants, we may decide to window dress some profits, whereas in the cash flow, all those things like non-cash item, all the
Please, I have
non-cash
a question
items,
to ask.
we add them back. But some people, they use, like, they can inflate their depreciation in order to do some dubious things, some provision, a lot of things are going on. So I believe that removing all those things, the cash flow is better than the cash profit, the accounting profit.
Accounting profits. Yes, that is very good. Yes. Madam Joy, you want to say something?
No. You're good.
Can I try?
So I want to
Yes,
say something.
you can try. Yes, you can try.
Okay. I think the cash flow is actually better than accounting profit because it gives more on strictly cash items. While accounting profit, we include other expenses that are not cash items like rebates, depreciation, and so on. They are not cash in computing in getting our profit. So cash flow itself, it is strictly based on cash items. So that will actually show us the actual movement of cash in and out.
Yes, that is very good. Yes, that is very good. You are reading your financial reporting very well. So the point is this, you're very correct. Yes. Have you asked yourself, organization will declare accounting profits. Even auditors will go and work on their books and they will still collapse. We have the case of Aaron, those of you doing audits. Yes. Whereby the reports provided by the auditor is not sufficient. Yes. To guide against the collapse. Even external parties rely on the report of the auditors. And in relying on the report of the auditors, the external party were misled. And that is why today, as auditors prepare their report, there will be a little disclaimer that they've only prepared the financial statement based on the available record, and they should not be held liable for anything. Madam Tai, can you help me with that? Can you tell me that thing people used to write when you prepare your financial statements? Or is Madam Rose, are you here? She's not here. These are the auditors I have that are practicing, which I'm learning from them. All what they need is to become chartered and blow up in a bigger way.
Amen.
Yes. So cash flow is often more important than accounting profit because it reflects the actual cash available to run the business, not just paper performance. Most of what we see declared in financial reports is paper profits, not the real thing. So a business survives on cash and not on profits. So a company can report high profits and still collapse. So, but it cannot meet its cash obligation if it does not have sufficient cash. So when you cannot meet your cash obligation, is a sign of what? Of insolvency. And very soon the organization will still liquidate. So that is why even when the tax people go to organizations, they add back those non-allowable items back to get their own taxable profit. Yes, they don't work with the accounting profit. And that is why they have to do some adjustment to get a taxable profit, because the accounting profit can be misleading. It can be window dressed and doctored. And that is why the cash flow is very key. The cash flow is very key. So let's pick this question. Talking too much in the class.
Sir,
Let's,
can you come here with those your
Sorry, sir. I have a question.
the list, the reason why is better? Number 2 and 3, sir.
I didn't even, I didn't state it by number. No. Okay, let me come back again. So, cash flow. I said,
Sir, I have a
okay,
question.
please let me respond. That's cash flow.
Sir, can you hear me?
I can hear you, but let me respond to the person that asked the question, to Madam Faith. So I said cash flow is more important than accounting profits because it reflects the actual cash available to run day-to-day business activities. And cash flow shows your present value. Yes, so if you go to your cash flow analysis in financial reporting, you have your investing activities, operating activities, financing activities, and where you are using your indirect method, there are certain adjustments, your operating segments, where you do your adjustments, where you add back all those non-cash items such as depreciation, profit on disposal of assets. Profit on disposal of assets is different from proceed on disposal of assets. So you add back all those issues. So this is to reflect the real cash elements, cash value of the business. So I went further to say that a business only survives on cash and not on profit. So issues of salaries, rent, taxes, loan repayment, and suppliers are paid with cash. They are paid with cash. So a company, I said, can report high profit and still run into problem of insolvency and still collapse. So if a company cannot meet its cash obligation as at when due, it means there is no reason for them to be in existence. So that is why cash flow is an important element over profit. So accounting profit is mostly affected by non-cash expenses and income, such as issues of depreciation, amortization, provisions, accrued income, and so on and so forth. So cash flow is very hard to manipulate. Cash flow is very hard to manipulate because profit can be influenced by accounting policies such as depreciation method, inventory valuation method, revenue recognition method, estimate and judgment. All these IAS you have in IFRS can affect your profits. You can use that to window dress your profit. You can hide under that to window dress your profit. So cash flow is more objective and transparent, making it a better indicator of the financial health of a business. Hope that is fine. Yes, Madam Costly, what is your question?
Thank you, sir.
Yes, Madam Costly, your question. Very fast, very fast.
Can you hear
Yes,
me,
I can
sir?
hear you now, ma.
I said sorry for throwing you back. I don't know how you got to 2.5 when we did in the other way, using the outlay 250, 100, and then the last 100,000 that we couldn't give to the next year. We were left with 50,000. So 50,000 all over 100.
Yes.
That's what you said, divided by 100.
Yes.
Then I had 0.5. So how did we get 2.5? I don't understand.
50 divided by 100, you have what, man? 0.5. Isn't it?
0.5, yes.
0.5 plus
Yes.
2. That is how we arrive at this
Okay.
point. 2.5. I don't know if this is clear.
Where is the 2 coming from?
The 2 in
Where is the
Second year.
2 coming from?
this is it. In year 1, you paid, you receive how much?
Okay. Okay.
100,000.
Yeah.
Year 2.
Yeah. I got.
Right.
I'm fine now. I'm fine.
All right. I'm aiming 8 o'clock. I don't know. Let me check if there's any class by 8. Let me see. Okay.
There's no class. We are starting by 9.
By 9. It's by 9.
Which class is that?
No. It's on the other platform.
Starting by 9.
On it's not on these. It's on Apex platform. It's not.
Sir, please let me use this medium to ask you a question, sir. And how many courses that do you take now? I think you do take a financial reporting and the financial management and also PM, isn't it?
No, please. I don't take all those things. I only take 2. I can't take all.
Okay. Thank you, sir.
Yes,
Please,
I
sir,
can
which
just.
course are they having this by 9?
Is FR.
Okay.
Sir, please take us also staff.
No, I don't have time now.
TikTok is not stable, oh. It's not
Can I
stable.
join
They
the
are not
FI
stable.
class?
I'll be FR. Take us FR.
Oh, I don't have time.
Please, can I
It's
join your
very
FI
demanding.
class by
You know,
9?
it's not to teach. To teach. Don't worry, I'll add it to the group. My mark.
All right. Thank you.
To teach is not just, you have to always be on guard to teach if you want to make impact. Yes. So it's not just, that is my own concept anyway. It's not just for me to just come to class, and I have to make sure I have my slide for financial reporting, yes, but I don't just, I've taken it before, but I have too much at my hand. I don't want to delve into what I will not be committed on. So I can say I will start and I will be disappointing the students. So it's better
You already have idea
based
for
on what is
teachers.
around me. I know I will not be effective. So let me just keep on with the 2 I'm taking. So
Sir, please, sir, for
And now,
nothing
we
is
shall
going there.
passing
Please,
through.
sir.
no, once it's no, I'm not even.
Okay, let's take our
I've
question.
never taken this. Yes, thank you very much. Let's take our
Can we
question.
concentrate, please? We don't have time. Can we allow me to concentrate, please?
Yes, I'm working based on time. So Johnson Limited is currently Johnson Limited is currently considering two mutually exclusive projects. Or exclusive investments. Mutually exclusive investment projects. And let's say both projects are concerned. Both projects are concerned with the purchase of new plants. Purchase of new plants. Company made available. The company made available the following
It's very
following
faint.
data for the projects.
Sorry, I've reduced the character.
Enlarge your screen a bit.
So we have A, we have B, we have costs. Costs. That is immediate outlay of this 200.
So I can't see your screen anymore.
120.
So please, can you please share your screen? I can't see it anymore. Okay, it's clear now. Seeing it.
We have expected annual net profits. Expected annual net profits or loss. We have it as 58,000. We have it as 36,000. Okay. This. One. Year two. We have loss of what? 2,000. And loss of what? 4,000. Year three. We have a profit of 4,000. Profit of what? 6,000. Expected residual value. Expected residual value. We have 14,000. We have what? 12,000. The company has an estimated cost of capital. An estimated cost of capital of 10% and employs the straight line method. Straight line method of depreciation. Straight line method of depreciation for all fixed assets. When calculating net profits. The company has sufficient funds to meet all capital expenditure requirements. Required required. Calculate the payback period. Calculate the payback period for each project and advise which of the two projects to be selected. From this question, what can you tell me? Yes, very fast on this
Sir,
question.
I have question. Sir, I have question.
Is it based on this question?
Yes, sir.
So what is the question, sir?
My question is that year two are still negative. It's all of them is negative. So how are we going to treat it? Are we going to sum together, then take it off plus the residual value, or how it is?
Yes, don't worry, we're coming to that.
I've not solved it yet.
So from this question, what did you observe? Do you have cash flow?
Yes.
You have cash flow.
Accounting profit.
Yes, we are not having cash flow, but we have what? We have
Accounting.
accounting. Have accounting profit. So for you to calculate payback period, what will you do?
We have annual net profit.
You need to convert your accounting profit or loss into what?
Into cash flow.
Cash flow.
So bring back depreciation.
Into cash flow. So based on this question, some of you have passed financial reporting and you are happy. So how will you determine your depreciation? Those of you that have passed financial reporting, tell me.
Because cost divide by cost minus scrap value divided by 3 years.
It's cost minus 3.
So I want to assume those people talking are those that have passed F1. So it shows you've justified your pass. So for you to get your depreciation is what? Initial outlay less scrap value divided by number of years. You get your depreciation. And the question made it clear that straight line method. It means if I'm using 2,000 for year one, year two will be what? 2,000. 2,000. So without much waste of time, let's quickly solve and see what they want us to do. So solution. We are expected to calculate payback period. Calculate payback period. Payback period. What are we going to do? Let me write this story so that I'll not get much question. From the question given above, annual accounting profits or loss we are given. Since what? Since payback period makes use of cash flow rather than accounting profits. there will be need to convert the annual accounting profits, or loss to cash flow before proceeding to calculate what the payback period. So converting accounting profits or loss into cash flow. What are we going to do? You need to calculate your annual depreciation. Annual depreciation. And to calculate your depreciation is what? Depreciation is equal to what? Initial outlay minus what? Scrap value divided by what? Divided by number of years. This is using straight line method, right? Now, for project A, I'll solve for project A. You go and solve for project B. For project A, your depreciation will be what? Your initial cost is what? 200,000. Your scrap value is what? Residual value?
14,000.
14. Another one for scrap value is residual value. So you have it as what? As 200,000 minus what? The scrap value is what? 14,000. 14,000 divided by what? Number of years?
3 years.
So what will be your result?
62,000.
62,000. 62,000.
Yeah.
62,000. 62,000. I will only solve for A. You solve for B. You understand? That is the way to learn. So we've determined our depreciation for project A to be 62,000. What next are we going to do?
Add it back to
the profit.
Yes, calculate
of year one of project one.
Calculate annual cash flow. Calculate annual cash flows. And how do you calculate annual cash flow? Cash flow is equal to what? Accounting profits or loss
Depreciation.
plus what? Plus depreciation. Accounting profit or loss or depreciation.
The 8,000.
So for project A,
58,000 plus 62,000.
yes. So for project A now,
120.
project A, We have our accounting profit, or loss. Here we have our depreciation. And here we have what? Our cash flow. So for year one, we have it as what? Accounting profit is what? 58,000. Depreciation value is what? 62,000. When you add that, you're going to have what? You have 120,000. For year two, accounting profit, this is accounting loss now. 2,000. Your depreciation is what? Your cash flow will be what?
Will give us 60,000.
For year three, the accounting profit or loss is what? 4,000. Depreciation is what? 62,000. Your cash flow will be what? 66,000.
Hello, ma. Good evening, ma.
So now, can we compute our payback period? Can we have body in our
Please mute
class?
yourself.
Our body in this
Oh,
class.
Jesus. Sorry, oh. I didn't know. I'm sorry.
Now you know. I off my tap.
Sir? Sir?
I'm with you, sir.
Yes, please.
I can hear you, sir.
This year two, we only is a loss, and the depreciation is also when you take depreciation out of these two, we have 60.
Minus.
How are you going to do it? Because I think that whenever it is lost, you're going to take it out of the cash flow, or how it is. I'm not understand that space, sir. Whether you get me correctly, I don't know.
I actually get you correctly, even beyond what you've not said, sir.
Okay, sir.
Yes. But I'm just imagining that this is the expression. This is how to get cash flow. This is the equation of cash flow. Accounting profit or loss plus depreciation. So if you have a loss is in brackets. Loss is taken away from you. You have a depreciation, which is a positive value of 62. You are taking loss out of 62, which is positive. What will be your result mathematically? See the equation. See where we started from, sir. Before we now express here. Cash flow is equal to what? Accounting profit or loss plus depreciation. When you have a loss, is a negative value. Minus 2,000 plus 62,000. What will be your result?
60.
60.
Okay. Okay. Thank you.
All right. So from this, can we calculate our payback period? Calculate payback period. Calculate payback period for project A, because you go and solve for project B. I don't want to see strange answers, funny answers. So for
I
project
don't
A,
understand which one be strange answer. Oh?
no, based on this computation, you understand?
Okay, sir. Okay, sir.
You will go and repeat for project B, isn't it?
Yes, sir. Please, I'll send the slide on time because I was going to the class. from the beginning.
So the strange answers I don't want to see, let me elaborate, is not following the step we are following here. Once you follow the steps we have here, you get the appropriate answer and result for project B. So by the time you don't follow these steps, what you will send to me will be a strange answer. That is interpretation. So calculate payback period for project A. We can have our years. We can have items. We can have the cash flow. And we can have what? Let's come up with a balance column. So now, as at year 0, how much are you investing?
200,000.
Cost.
200,000.
Costs. There's an outflow of 200,000. There's an outflow of 200,000. As at year 0, the balance is still 200,000. In year 1, do you have any inflow?
Yes, 58,000.
120,000.
Is it?
Cash
120.
flow.
120,000.
120.
See it here. See it here. 120. You have an inflow of what? Of 120,000.
Sorry, sir.
Are you
How
ready?
do we get 120?
Can you see this highlighted region? Can you see? Accounting profit or loss plus depreciation as at year 1. See it here. 58 plus 62, 120.
Yes. Thank you, sir. I've seen it. I got it.
So 200,000 minus 120. How much do you have left to get?
80,000.
80,000.
In year 2, your cash inflow is what?
60,000.
60,000. 60,000 out of 80,000.
20,000.
20,000. 20,000. As at year 3, your cash flow is what?
66,000.
66,000.
Yep.
So this 66,000 in year 3, if you should remove 20,000 out of it, you know what we're trying to determine is the period.
How long it took to pay?
Is the period we'll recoup our 200,000. So we can recoup our 200,000 from all indications between year 1 and year 2, and part of what? Year 3. Isn't it?
Yes.
Yes, sir.
And part of year 3. So for you to know the number of months or years that you will pick out from year 3, what will you do? We showed that
Divided by
not
12.
long. So
20,000 divided by 66,000.
yes, the payback period will be what? Payback period will be equal to what? 2
2 years
plus what?
plus
20,000
20,000
divided by
divided
what?
by 66,000.
Divided by 66,000.
So why not divided by 12?
No, I'm not dividing it by 12. We want to see this 60,000, this 20,000. How many months will it take you to recover that from year 3.
3 point.
So it will be 20
I
divided by
see.
66. 20 divided by 66. So the payback period will now be what?
2.3.
2 point what?
2.3.
0.3.
2.3
That's
years.
2 years and 2 years and 3 months.
So for project B, what would the result be?
It was 1 minute.
For project B, what would the result be?
It's not working.
Depreciation is 36,000.
So what it's very fast. Mr. Charles, are you in this class?
Well done, sir.
Thank you, sir.
Sir, I understand everything that you did. Just that this our one cost, that's 200,000. Where do we get it from? That's area I just confused. Thank you, sir.
Say the question, sir. Cost, immediate outlay.
Okay, sir. Okay.
So I will conclude by talking about accounting rate of return. Once you give me the answer for project B.
Today?
By the grace of God, sir.
And then we have class 2.
Don't worry. I don't want to be carried back. People have this.
So project B will take 2.36. That's about 2.4 years. 2 years.
4 years.
That is very correct. Yes. So if you have not gotten that, you can get that after the class. Take your time and get it.
Wait, is it project B? Is what is
Yes.
Project B.
Project B is 2.4 years.
Yes.
So the question is required. Calculate the payback period for each of the projects. Advise which of the 2 projects to be selected. So what will be your
Project A.
Why?
Because
it has.
Yes. So based on the computed answers, project A has a shorter payback period of 2.3 years compared with project B with a payback period of what? 2.4 years. So I will say project A is preferable to project B. However, the acceptability and the selection of project A will depend on the management targeted payback period.
Okay.
That's right. Let me solve my own.
So
Please, sir, send the slide on time because I was not writing anything.
Accounting rate of is not something too big. That is why I want to actually talk about it instead of coming back to it in the next class. So accounting rate of return. This aspect of non-discounted techniques, it's major on what? On what? Yeah, so accounting rate of return is based on accounting profits and not cash flow. And not cash flow. As you can see on the screen, accounting rate of return is a non-discounted method that makes use of accounting profits as shown in a company's financial statement. It is also known as return on investment, ROI, or return on capital employed. So this accounting rate of return, similar to payback period, when cash flows are given, yes, it is similar. So it should be converted to accounting profits. When cash flow is given, you convert your cash flow to what? To accounting profits before you can solve for accounting rate of return. Now, how do you calculate accounting rate of return? You can use various forms of formula, or you can use a formula to calculate accounting rate of return. And what is this formula you are to use? You should have it here. You don't need to type again because of time. Yes, you have to use this formula to calculate your accounting rate of return. So accounting rate of return can be calculated using the following formulas. Now, to get your accounting rate of return, you need to determine what your annual profit is, estimated average annual profit in a question. You need to determine that. Or in a question, you can be given
I can't see screen.
I think he went offline.
still talking about the accounting rate of return. Talking about the accounting rate of return, I said we can use various forms of formulas to compute that. We can use various forms of formulas to compute the accounting rate of return, as you can see on the screen. You have the estimated average annual profits divided by estimated average investment multiplied by 100 over 1. So your average investment is what? Your initial outlay plus what? Your residual value divided by 2. That is how you determine your average investment. And how do you determine your annual depreciation? Just as we've considered while solving for project A of recent, you can determine your annual depreciation by saying your initial outlay less residual value divided by what? Your useful life. Divided by your useful life. So now, what will be the basis of your decision when solving for accounting rate of return? For independent projects, the decision criteria will be what? Accept a project if the accounting rate of return is greater than or equal to management predetermined accounting rate of return. Same likewise where you have mutually exclusive projects. Let's see if I have an example here. So we have this example here that Samsung Limited has a targeted rate of return of 22% and is now considering the purchase of an asset with the following information. The capital outlay is 85,000. Estimated profit before depreciation. Before depreciation is what? Year 1, 18,000, year 2, 25,000, year 3, 38,000, year 4, 45,000. Expected residual value is 2,000. Required, calculate the accounting rate of return, advise on the acceptability of the project. So what do you think we can do in this regard? First, we need to get our depreciation, right? Because what is given is what? Is cash flow. These parameters here, they are cash flow because estimated profit before what? Depreciation. This is not accounting profit. These are not accounting profit. They are what? They are cash flow. So solving for accounting rate of return, you need to get what? Your accounting profit. And for you to get your accounting profit, what will you do? You need to determine the value of depreciation. Now, looking at this screen now, what will be your depreciation? Your depreciation value, year in, year out.
20,750.
20,750, very good. That is what? Your initial outlay is 85 plus the residual value, 2,000. That is less residual value of 2,000. Divide by how many years? Divide by 4.
4 years.
You have 2750. 2750. Let me just show it, even though I don't have time. Show it. So we have it. Annual depreciation. Annual depreciation will be what? Will be equal to what? Your initial outlay. I don't need to write all those stories again. Initial outlay plus what? Plus your scrap value given in the question is what? Is 2,000 divided by the number of years, which is 4. When you do,
It's minus or not plus.
This is minus. So when you do this, you have what? This will be equal to what? 20,750. So for you to calculate your profits after depreciation, what will you do? For you to calculate your profits after depreciation, the accounting profits after depreciation, which is the accounting profit, it will be what? For year, we have year 1 to 4, year 1, year 2, year 3, year 4. So profit before depreciation, you have it as what? Profit before depreciation. The profit before depreciation for year one, you have what? 18,000. For year two, you have what? 25,000. For year three, you have what? That's 8,000. For year four, you have what? 45,000. Now your depreciation value is what?
2750.
So you less that for every year. 2750, 2750, 2750, 2750. So your profit after depreciation will now be what?
Negative of 2,750.
This will be
Cost of 2,750.
and this will be what? And this will be
4,000. Okay.
This will be what? In total, this should be what? In total, this should be what? In total, this should be 126,000. Now, for you to calculate your average profit, what will you do? You know, we need to, your average profit, what will you do? The total profit after depreciation is divide by what?
2.
No,
25 by 4,
four.
sorry.
By 4.
By 2.
So, average profit. Average profit, the number of years is 4, so the average will be what? 43,000 divided by what?
Divided by 4.
The result will be what?
10,750.
10,750. Your average investment will be what? Average investment will be equal to what? Your investment as at the beginning is what? Initial outlay, 85,000. Plus the scrap value is what? Is 2,000. So 85 plus 2,000 divided by 2. You have a result of what? You have 43,500. So what will now be your accounting rate of return from the formula we've shown above? Your accounting rate of return will be what? You know, you've been able to determine your average annual profit, your average investment. So what will now be your
25%?
Okay, 25%. 25%. Yes. So your accounting rate of return will be equal to what? Estimated average annual profit is what? 10,750 divided by what? Estimated average investment is what? 43,500. Everything multiplied by 100 will give you what?
25%.
Will be equal to what? 25%. 25%. So comparing these results with the target of the organization, 22%, what will be your advice? What would be your advice? When you compare your results of 25% to the target of the organization, 22%, what would be your advice? The advice would be, since the project RRR of 25% is higher than the management targeted RRR of 22%, therefore the project should be what? Should be accepted. The project should be accepted. So that is an accounting rate of return for you. I'm going to send questions for you to solve. Why I quickly talked about this, because in the next class, I want to talk about inflation in investment appraisal. Inflation in investment appraisal. So that is why I don't want to come back to this issue. I want to see how we apply inflation to these variables. What will be the effect of inflation on these computations? So that will be the discussion in the next class. So I will send a question. I will forward a question now. Is an ICANN question on MPV, internal rate of return, payback period, and accounting rate of return. I'm going to forward the question now as soon as I end this call, so that you can play with it. So I expect everybody, we are about 25 before, that's reduced to 22 now. I expect everybody to attempt the question, send the question, send your solution to that group. Yes, send it. I want to see your attempts. But by the time I don't see it, it means the tempo in which I will teach to will reduce. So it is your aggressiveness towards assignment that will also make me to be aggressive towards lecture. So, Madam Ineka Choma, I can see your hand up. What do you want to tell me, ma'am?
Yes, sir. Thank you. Thank you very much, sir. Sir, so I
The
just want
hand
to
is
ask a
up by
question
mistake.
about MPV. No, sir. Sir, can you hear me? Hello.
I can hear you. I can hear you.
Okay. So I want to ask a question on MPV. There is this question
All right.
on last diet question on MPV. It's quite
Okay.
different from this particular MPV. So I don't know how to actually go about the question. It's not like straightforward like this one.
Auntie Neka. Auntie